Thank you very much, everyone, for coming. We appreciate it. It's always nice to be back at Cyprus in this beautiful weather. We've got amazing panelists with us coming from different backgrounds. We're going to talk about liquidity today. We're going to discuss, the recent geopolitical changes and challenges and how that affected liquidity into the market space. I'm going to allow the panelists to maybe 30 seconds each to introduce yourself, and then we'll start with the questions, please.
Good afternoon, everyone. John Murillo, Chief Dealing Officer at B2 Broker Group of Companies. We are a liquidity and technology provider. Great to be back in Cyprus once again.
Good day. My name is Ivan Virko. I'm head of banking and OTC, Advanced Payment Solution. We are a payment service, payment company, fintech company.
Good afternoon from my side. I promise we're not going to keep too much of your time, being the last panel and everything. My name is Alexandros Patselidis. I'm Vice President of GTC Prime, GTC Group, and I'm very happy to be here amongst colleagues.
Good afternoon. Elena Pedersen, co-founder of Yorbus, the fastest trading execution technology on the market. And I guess I'm representing here the resilience of the technologies when it comes to liquidity.
My name is Andreas Kapsos. I'm the CEO of Match Prime Liquidity, regulated by SISEC. Happy, of course, to have the usual suspects on the panel and happy to share our latest updates with you guys.
Thank you all. As you can see, we have people from all different backgrounds. We have technology, banking, and liquidity. So this should be, give us a lot of different angles to the liquidity. And Elena, you said resilience, and that's kind of the main thing that we want to talk about now to start with. We've seen in COVID, when markets start to have that volatility, we've seen a lot of breaks. After that, there was a couple of flash crashes and liquidity, specifically for gold. But now with these kind of, geopolitical challenges that we've been facing, although the market was extremely volatile, we haven't seen that kind of interruptions. Or maybe it was seen, but it wasn't kind of visible to the end client. Does that mean liquidity in gold has genuinely kind of improved, became resilient? Has been there any fundamental changes on how banks are pricing their liquidity? I guess this is the first topic. Or is it just kind of a technology-related resilience I don't want to direct the question to anyone, so anyone who feels like ready to jump. John, I have to start with you because you're the closest. So,
well, I think our industry is at a maturity where some of these geopolitical events are managed quite efficiently. Obviously, it will always come down to tech vendors, who's pricing into you, what is that tech behind for stability purposes. I think the market, despite the volatility we've seen this year, irrespectively has done, and I believe has performed quite well. It's been an orderly, systematic pricing to the situation we're going through. Again, that comes through a lot of us engaging very closely with those makers behind the scenes.
I will tackle it a bit differently. Although I agree 100% with John, I will tackle it from the other way around, from the client side. So we've seen it from the client side that if we let's say, take everything back, the whole scenario 10 years ago, I'm sure we wouldn't react this way. So I strongly agree with John that we developed, we embraced what came in, and I think we all managed to be here and be able to tell them what we've been through and how we handled it, which is great for the business and for liquidity in general.
I think from liquidity provider standpoint of view, of course, yes, technology adapted and geopolitical, as John has mentioned, situation doesn't affect the tradability as much anymore, if that makes sense. Of course, we saw the data outage with COMEX, and that's a completely different thing we can address. But I think right now, because of the past events, the liquidity providers, especially the ones in this room, really had to work and increase their balance sheet in order to be able to support the trading conditions that are expected, especially in the retail market. And I think now it's not more about the geopolitical event, it's more about who can reliably get out of the trade when they need to get out of the trade, and which liquidity provider can facilitate that to those brokers.
And sorry, just John, I think what happened last time as well. There was a lot of triggering of circuit breakers.
Yeah.
And when the market has moved so much and the volatility is there, and I don't know, is that an evolution of the liquidity provisions or is it an evolution of the technology provisions? We'll get you, John. Maybe if you can.
Yeah, please go ahead.
Yeah, basically, I said that market, of course, stronger now than they were before. And every crisis leads that many companies improved their VARS models, stress testing, risk scenarios, very important operational, legally agreements, liquidity plans, yes, but it's actually only for last crises. And we don't now prepare for next crisis, what we have not seen. As example, in COVID, many people have seen that the price on oil can be negative. And I know a lot of risk department don't suppose in their models, in their reports, that it can happen. But now, a lot of investment investment house prepared for this.
Yeah.
And before we didn't have seen negative interest rate, yeah, and now we prepared. But in the future we didn't know what kind of surprise we will face. And we are strong, and we are not strong. We are weak.
I think I would like to come back to the statement you made. I believe this is very, very important. A lot of times when you're running a liquidity business, there is an underestimation of how much capital you actually need to run it, if that makes any sense. I think a lot of us who've been doing this, this is 25 years, I'm in it, we understood from an earlier stage what it means. And coming back to this point, though, and I think this is very important for all of us in the industry, is educating our partners is part of an ongoing process we all have. It's our duty, it's our responsibility, because when we go to our PBs, they don't understand what our world looks like. They got their own way of pricing you, right? So balance sheet becomes critical to scale your operations and for guys like us to facilitate that service out to the end user, ultimately.
And I couldn't agree more. I mean, the capital is at the top of the priorities when it comes to liquidity. Without it, I don't think anyone can survive. And kind of the stress test shows the reliability of these companies. Okay, Alex, maybe.
I would like to just say something. I agree with all the comments that have been made by my colleagues, but there is one more thing. Having gone from crisis to crisis, yes, we learn, we develop, and we set up the appropriate processes in order for these kind of problems not to recur. But there is also another fundamental change. I see from our perspective, what we're doing with our clients and with our partners as well, we're being far more transparent. So we communicate much more transparently and telling them, okay, this is what we have faced before, this is what we predict we're going to be facing. We work together in order to do it with our counterparties, and then at the same time, we're educating our own clients. So transparency and being able to talk as an equal from both sides is very, very critical, in addition to having an enlarged balance sheet in order to weather any kind of storms that come.
I think what a lot of retail brokers, I don't want to say don't understand, but maybe don't pay attention to, is the balance sheet. That's not just the counterparty relationship, which of course is really important, and you need to have several counterparties and being able to switch between them in case of outages, for example. But it's also the ability of the liquidity provider to keep quoting at a certain standard when those venues stop quoting. Because ultimately, very often, you accept the responsibility of saying, actually, you know what, I'm going to carry this risk until I can offset it. And that's a decision I make because I've made the promise to my clients to continue quoting. And we see that a lot, especially like as a technology, because we see your liquidity providers and we see what you are quoting to your clients. And very often, it's the conditions that retail brokers receive, in fact, not very often, 100% of the time, is so much better than what's really available on the market, especially during outage.
Andrea?
Yeah, I just saved 3 points. One, the stress test, which is very good because this year it gives us the opportunity, because I see it, I'm quite optimistic when it comes to that. I mean, doing stress on your business is very important. This year, the volatility helped us to make this stress test and see where we stand. And obviously, this is a very good feedback for all of the experts that manage the risk and the dealing on the B2C side. I'm talking about us now. The second is the communication that you, Alex, mentioned, and also John, which is also important because you need to be able to transfer why you're taking these changes, why I'm making these changes right now. The majority of the clients understand it, but some of them don't. And when they will look for something else and go to another one, and they get the same feedback that we will give them why, then they start to understand. Maybe it's a bit late for them, but still they will get the right message. So let's say they come to us and we give them something, and then they come to you guys, and you said this. Then they realize, this is a market norm.
So it becomes a standard.
Exactly. So they will accept it. So it's once again why between us we speak, we communicate, and we collaborate in order to have the same message out. So this is also something which was new for us this year, to communicate and also communicate the same to the clients.
Yeah, and I try not to say my opinion as much as I can as a moderator, but I feel capital is like a basic. Correct. If you want to be in the liquidity business, that's the basic. And then after that, whatever liquidity or technology you want to choose, that becomes your choice. But capital is basic. And after that, communication. And this is where we have the funding gaps, we have the pricing gaps between the retail, the prime of prime, and the PB. And then education becomes important as to kind of like how to bridge that gap. But capital, I think, is non-negotiable, because in these events and all the stress tests that we do, it's all about how much your capital can take these fluctuations. And
it's correlated as well. I mean, it's a domino effect. So it affects your product, it affects what you give out. Yeah,
everything.
Yeah.
And also, I would just like to add, apart from I agree 100% with you, but another part is how well do you do your own risk management? And how well does your risk management correlates with the risk management of your counterparties and how aligned you are, okay? Because you are providing a service and you rely on your counterparties to meet that. But do you do the proper risk management, and do you have the appropriate circuit breakers if something goes wrong? So there's no collapse happening.
True. And definitely what Ivan mentioned as well, kind of the scenario analysis that we're now prepared for are a lot more extensive than we had before.
And VAR is that, like it's all stress testing now. So.
Exactly.
But about risk management, then low risk, low profit.
Of course.
Yes, but when volatility is low, counterparties or market players want to earn, yes, but spreads tight. And need to find compromise and need to rise risk appetite.
Yeah.
And every crisis comes from low volatility and calm markets, because leverage rise, risk appetite rise, it leads to crisis.
And I guess, we've talked about this in Singapore a couple of months ago. We talked about BCPs as well. The stuff that we've always been writing and we've never looked at, and in the last 6 months it's all been about what was there in BCPs. Elena, you probably had something. When the AWS servers were kind of hit, there's like disasters all over the place. BCPs became kind of the essence of what we do as well in terms of.
I think it all depends on what is expected, right? So, for example, at your Börse, we know, because our background is brokerages, we know that there should be zero downtime, right? So we run several models, we have hot backups, cold backups. So, and downtime in general is not acceptable, and even during the weekends for us specifically. But unfortunately, like with someone like Comex, you can still see someone going down for 10 hours.
Exactly.
And liquidity providers having to source the liquidity elsewhere. But I think when we come to this, again, what I want to say is that, very often with liquidity, what I see is that very often there are liquidity providers that treat it more as a cash flow business. And to me, this is the biggest issue that you can have, because then ultimately it affects the trust of the industry. And this is where you find the biggest disconnect. Because if you look at, again, even Comex, and you look at the price that they have for gold or other instruments that are derived from the futures markets, let's say, and the price that we give to our clients or the end clients, it's so disconnected that when you say, oh, risk management, right? What kind of risk management are we talking about if we look at the gold and whatever we offer to the retail client? How are you to offset that position? The only way is to have a really strong balance sheet and to sit on that risk and actually take that risk on.
But again, balance sheet is also important in the risk scenario as well as the numbers scenario.
For example, if you provide hedging services in gold, hedge to sell gold, futures or forward on gold. I know a lot of banks don't provide the service for companies, legal entities who don't produce gold on export. It's called its name right-way risk. Yes, and this bank doesn't work with client with wrong-way risk. It's about risk management. And after, as example, 2014 ECAC region, I know a lot of companies with local FX revenue can get loans with foreign FX, foreign currency, because it was cheaper. But when local currency devalued on 2 times, we have seen a lot of bankruptcy, because government air companies, travel companies didn't can serve their loans, because they serve wrong risk loans. And after this, a lot of companies, a lot of risk departments improve their risk management. And after, we didn't see any FX spikes on FX markets.
Definitely. I mean, it seems like
risk management works.
Yeah, of course. It seems like for the past, I think, 5 years now, we've only been talking about gold, right? And it's just kind of like an endless loop.
That is changing.
Yeah, and that's exactly what I want to ask. I mean, have you guys started? I mean, we've seen oil maybe do some decent moves and indices at the all-time high. And gold volatility is kind of, I wouldn't say dying down, but a little bit more controlled than it used to be before. What do you guys think?
It's calming down.
I hope so.
It's calming down.
But do you think we'll get enough volatility of the other asset classes for us to kind of divert away from the concentration of gold? Have you started seeing this already, or?
I think about gold, yes? About spikes on gold.
No, about diversification away from gold and asset classes having more traction.
If you investment house or hedge funds, yes, it works. But if you gold miner, and you need to hedge your position, and you sell forward on gold or swap, you expect that you will get gold revenue of selling of gold through 2 months, and you need to keep derivative hedging position, and need to keep your initial margin, as example, 10% of your all volume.
Yeah. How about
when gold rise,
I know you
need to add initial margin, But when gold, when we see spike and when price rise very very fast, gold miners don't have liquidity, and they need in short time to close the hedging position, and this push markets. and also arbitrage companies, arbitrage funds who trade, for example, gold, sell on one market, buy on another market, and
my question was
station.
more related towards the FX brokerages. We know where we had the biggest concentration. Elena, also you deal with a lot of them.
I have the stats, but I want Andreas to
Yeah,
respond.
Andrea, you can.
Well, yeah, we had.
Please tell me good news. Please tell me some good news.
Yeah, we had this discussion outside, and quite interesting actually, because we were having a discussion because at some point we reached a point where gold spiked up so high that it was very concentrated, and we all came to terms that we all seen that. The last weeks, we can say that it's been more relaxed. We have the crude coming in and taking some of that percentage as well. And also, Elena mentioned that she noticed also some crypto increasing, which is something.
Because we have statistics across, all other brokers. We can see that crypto went to like 10% now from 3%.
Wow.
And gold went from 80 to like just below 60, which is.
Yeah.
The interesting part would be to see how gold will react, the concentration on gold will react again, because if there is an agreement being done now, I assume the crude will be a bit volatile, they will trade a bit more, and then we'll see if it goes back to the sentiment of gold being traded the most by miles.
But indices as well.
And indices, yes. We've got, we had some increase on the indices as well.
So, Alex?
Which is nice, which is good, because we have the diversification that we all wanted.
Thank you. So what we see from our clients, it's interesting. It mirrors exactly what my colleague said before. The concentration on gold is kind of like easing down, which is good. It gives space for liquidity to recover. But at the same time, due to the geopolitical events happening, which are very closely interlinked, they just happen to remember that, okay, there are other asset classes and other things that can actually invest their money on, just like oil, crude, indices, CFDs, and so on and so forth. And crypto is always, of course, it was about time to go a bit up. So we do see this with actual figures, and we see this happening. Having said that, we need to wait and see if gold, which had a huge rally over the past few quarters, is going to continue the uprise, or if it's going to have a more stable position and people are going to hedge with other asset classes and other instruments.
Cool. What about you, John?
Well,
give me good news, man.
There is. We're a reflection of the industry as such. So what we see is obviously the geopolitical situation brought a ton of business on oil and Brent and whatnot. So we moved into, we divert. I've seen flows diverting for what it was a precious metals driven market, almost 80-90%, which was pretty scary at some point, over to commodities. And I see a lot of equity indices business coming in once again. Now, it seems like the industry forgot about foreign exchange.
Yeah.
There's no more euro, cable, none of that stuff. But
that was exactly going to be my question. Is it coming back? Is it all coming back?
I think this year is going to be very interesting, right? We're moving now into the summer. Obviously, historically, the markets go a little bit quiet during summertime, but we have US elections, midterm elections. This is going to get a lot more exciting. We should have a very interesting third and fourth quarter for all of us here.
That would be good.
But definitely
of the majors.
Yeah.
I think we're definitely going to see different asset classes being traded more frequently than for the last 1 year.
It's all about the volatility, isn't it?
Yeah,
I mean, you need some volatility into the FX market as well, and this hasn't been. Gold is the only asset class that have sustained, systematically had volatility in the last 5 years. Like you said, oil came and then went back, and indices, they have their rallies and then they stop. But gold is the only one has been, and people started to have like actual belief that gold is gonna double in price, and they're buying at the highs now,
Well, you're based in the Middle East, so maybe you will tell me, because I'm curious, because I'm wondering how much of it is actually...
Buy gold. It's going up.
how much of it is a geopolitical factor, and how much of it is some influencer sitting there on TikTok being like, follow me, buy some gold because gold is so trendy.
Yeah.
And like, you know, it's easy to understand gold. It's maybe not that easy to understand some other asset classes.
I mean, I think, you know, I think it's all because gold as well, people are buying a lot of physical gold now. And us, even as a company, we have kind of, you know, launched a new business line in Dubai to deliver physical gold. Because there's so much demand on physical gold. Like, yes, with all of this uncertainty, people are just, you know, they're looking for the safe haven. But the problem is as well, a lot of it was supported by big banks issuing reports. JP Morgan put the target for gold at 7,000. So that's heavily supported by, obviously everything is now been revised. And it's now, they're saying they're going to be trading around 4,800 by the end of the year. So, you know, obviously the analysts, they come and they support the trend. And then when the trend comes back, they start supporting the different side. Is it their genuine demand? I think China is the main catalyst for the gold price increase, isn't it?
But
like
that's speculation. That's not.
Now, what about coffee and cocoa?
We wish, I mean, we want anything to draw attention. We don't mind what it is.
Same dynamic, but it's not gold.
Yeah.
It's virus.
Maybe it's less liquid. Maybe it's because it's only traded on the future market.
It's several stages. Natural reasons and after social media, speculation, liquidity crisis.
Yeah. Probably gold is more of a relatable product, I think, you know, because it's related to...
Gold is more liquidity, maybe.
Yeah, yeah.
Is silver still underpriced, you would say?
We've been doing a lot of silver for the
that's
first
what
time
I've
ever.
noticed.
Yeah, that's another big one. That's
It's
another
like
big one.
suddenly people remember it existed.
Yeah,
Palladium, copper. So
that's true. But liquidity needs to catch up on that side, right?
absolutely.
Yeah.
It's not the same product. That's where the misalignment lies. A lot of people believe is price action should be similar. It's not.
It's not.
Nowhere near the same.
I agree.
But they're all correlated at the end of the day.
And even capital requirements is quite different. I mean, margins in silver are extremely different than
very
gold.
costly.
Yeah. So that's a whole different. So it was very, very nice of you to bring that up because it was like we're thinking about what's going to be the next problem in the industry, and it could be these new metals, silver, platinum, palladium, and all of that coming into as, you know, the new things that people want to invest in. But there's a lot of work that needs to be caught up on the technology side, on the liquidity side, and the capital side. I think maybe, I don't know if there's something that we need to be preparing for.
Well, I always just give two advices to people who start a broker, do the broker. I always say, like, well, yes, technology has to be reliable. You need to look at your backups, but liquidity, do get several sources because and make sure that you actually vet your liquidity providers because getting, I don't know, 50 of the same is not very useful if something goes wrong, right? If I don't know, I'm not gonna use those liquidity providers, but if someone pulls out, like you need someone who's actually still quoting and that you can get out of your position, and that's the most important thing.
That's true, but at a higher level, like I remember at the beginning of last year, 2 out of our 3 PBs, they did not have silver. That you couldn't get pricing on silver. So you had to go through a broker or you had to go through the future market, but PBs didn't do it. But now I feel like they're all starting to, but the margins are extravagant.
And that's where you as a business, you need to make a decision. How are you going to position that to your end customer? And therefore, the ultimate beneficiary here is the broker-dealer. But then how will they pass that on to the consumer? Ultimately, our customers, right? And that's a very challenging formula that there isn't a perfect balance.
Right.
It's more of a relationship. It's more about knowing who you're doing, you know, what's your business relationship like? Am I willing to take that sort of funding gap and how far do I want to push the envelope? Because we all know this industry is wonderful until the music stops playing.
True. And you know what I saw as well, what I noticed is with the retail brokers, a lot of them, they have been trying to price, you know, all of the metals the same. So gold, silver, platinum, palladium. And because there hasn't been any activity on it, it was fine. So margining silver, margining platinum, exactly like gold. But you know, nobody kind of paid attention.
Margining needs to change in general, in gold as well. Like,
but yeah, and that's what needs to catch up. Even like with equity, sometimes you have 18,000 stocks on your platform. Some of them maybe doesn't price for 2 months. Nobody cares because nobody even noticed it because nobody traded. But if somebody comes and trades it, then it becomes a big problem that you need to look at right now.
That is the major problem that we see from the B2C brokers. I mean, they're always being a bit reactive on situations, and then we have to kind of explain. I mean, we've been saying it for years, like be proactive and like take the right decisions and like be ready, have multiple LPs, make sure you have different, obviously, execution venues. But we've seen it recently that they're being reactive again, and we have to give a solution on the wrong timing, and they struggle to understand what we're telling them, which we can take what happened now and learn from it. So going to your final question, like if something happens in the future, they will be ready to face it and embrace it in a nice way so they can benefit their business.
The regulators always say, make sure you have multiple liquidity providers. They don't say it just like that. They want to make sure that the broker is going to be safeguarded should something happen, yes? So when we get new prospects and they become our clients, and especially if they're startups and we're their only liquidity provider, we do tell them, okay, we will work with you, that's not a problem, but we advise that you get a secondary LP just to be on the safe side should something happen to us. Not many LPs say that because they would rather just keep everything themselves. But I would be very happy to recommend any one of my colleagues as a secondary or a tertiary LP. But this comes with knowing the market and knowing what my friendly competitors do and being able to proudly say, yes, you can work with them, I know them personally, and so on and so forth. So again, we're going back into relationships that have been built over the test of time.
Yeah, and something Andrea said as well, which is basically, if all the LPs or the prime of primes have acted, and adjusted, the clients will get used to it. As far as we don't have anyone kind of, doing something crazy, we level the playing field. Then the added value becomes more about, the technology, the service, what kind of solution you can provide. But the pricing needs to be standardized, not to the dot, but we need to be all aligned in terms of how we price how to price our clients. Wouldn't you agree, John?
Absolutely, and remember, we've had a few panels over the years.
Yeah.
I remember we had a conversation in Hong Kong not long ago. I think the race to the bottom is over.
Yeah.
The markets, correct. The markets have shifted to repricing accordingly. I remember hearing people asking for 5 cents on gold, where the underlying market is 100 cents, like it's $1 or so, depending on where you outsource liquidity from. I mean, we aggregate. Obviously, we have a very nice top of the book that everybody loves, but the underlying market is totally different than what people see out there.
Yeah, it will serve and it will attract in the short term, but in the long term, it will bounce back. It will change, and in my opinion, you will not be ethical towards the client, because if you attract them, let's say by 5 cents now on gold, you'll get business, but what's going to happen in, like, say, 2 months with such margin, with such leverage, with such situation right now?
Yeah.
You'll be exposed. We've seen it.
No, but you know what's going to happen, John? If everybody decides, okay, let's just look at the benchmark and let's adjust, and we all decide, right, we're going to reflect the reality of this, and all of us are going to do it. What's going to happen next? And we've seen that before, 5-7 years ago. Some joker recycler over recycler going to come in back with 5 cents and make it a cash flow business until they explode.
Can I comment on? It's true. You will always have someone offering something a bit outside the cycle, let's say, and it will be attractive, and it's obviously a business where anyone can offer whatever they want. It's no problem. But if someone would do something like that the last 8 months, I think he would pay the price very expensive.
Yeah, for sure. But the client is paying the price. That's a problem for me,
That's all again.
The clients will pay the price because most of these, they're not going to be
right.
capitalized enough.
It will have an effect on the client.
So the risk runs a lot on the client as well, you're saying?
Just to add on this discussion, something very interesting. There is one particular non-bank massive operation. They were coming to market with 5 cents or whatever you wanted to ask from them. They were offering, and it looked really, really sexy as an offer. I remember thinking about it like, wow, this is incredible. In my humble opinion, that's nowhere near feasible.
It's not feasible
in the long term.
Yeah.
I mean, yes, you gain traction, but that's not sustainable. There's reality. My grandmother always used to say, not everything that shines is gold. You always have to look at what someone is offering you and say to yourself, does it make sense? And they blew up this year, coincidentally. And this is a massive
They
operation.
chose the wrong year to try it,
Yeah.
Yeah.
obviously.
The market doesn't...
Not sustainable, yeah, and yeah, the market has
The market never forgets, because it may allow you some time to do your own thing, okay? You might be profitable for a brief period of time or a longer period of time, but the market will never forget what you did. And like I said, back in the FMLS panel in London last year, if you do something wrong, the market is going to chew you and spit you out. And then you're going to pay the price. But unfortunately, it's the client who's going to pay the price, like we all said. Yes?
Yeah.
But I need to say something else. As everything changes, technology changes, and technology right now, like the services that Elena is offering and everything, allow the liquidity providers and the brokers themselves to have a more hands-on point of view of what is going on. So there is really no excuse not to have good monitoring and good risk management, and to have a team that can facilitate and make use of those tools that companies like yours, Elena, provide in order to conduct their business even better.
Yeah. Yeah, for sure. And you know, like we've lived through, you know, I've been also in the industry 23 years, and we've lived through a lot. What I'm trying to say is, no matter, you can be extremely smart and you can do a lot of things, but the differences in the pricing isn't going to be that big. Like, we all do pretty much the same thing when it comes to how do we get our pricing. So when somebody is 50% of the market, something is wrong. Now you can beat me by 5% or 10%. You and me, we can do these things differently the way we look at. But the standard shouldn't be that far off. And that applies to pricing, margining, and all of the other aspects, swaps, everything, all the aspects. We only have 3 minutes, so I'm going to allow maybe if there's any question from the audience. I was going to actually name you, but because I didn't see you.
Say your name.
Okay, we have the biggest problem, Hormuz,
We have the biggest problem in the
asking
world.
the next
He's
question.
not allowed to ask questions.
Change your name.
Hi guys, I'm from ATFX. I have a question about, so the title is, can markets handle the next shock? I wanted to ask a question whether can brokers and market makers handle the next shock? And I wanted to ask, so imagine if the gold moves up or down $1,000 over the next 5 days.
Great question.
Okay,
I love it.
Up or down, next 5 days, $1,000. So it's just all of you to answer up or down is the answer. Which one would hurt the market makers and brokers most?
I'll start. I'll do something
He's trying to
quick.
get information now.
Sorry.
It's a one word, up or down.
No.
No. You know,
You guys answer. No, what I believe, I'm gonna do a 30-second answer, and then I'll let the guys.
Because you're not.
If you have the
You know
right,
what?
if you have the right type
should
of
answer.
clients, your exposure should flip. So it shouldn't matter which direction the market goes. The clients should flip,
5
and you shouldn't be hurt in either direction.
Within 5 days, $1,000. That's a big move.
Yeah.
Yeah. Elena, you want to answer, or
That's
shall
my
I?
opinion.
Shall I
I might be wrong.
The brokers don't want to answer, Elena. So you go for it.
no. I mean, come on, Homos. Is that did our lunch cause that question when I asked you how much it's going to cost you to get out of your gold position? Okay.
Up or down, which one's going to hurt more?
5 days, it's not a lot. I think it's a big problem if the
I think
price
down.
moved
I
for 1
think
day.
it's got-
For one
I'd
night.
say down. I go down.
One night, it's problem.
Yeah.
5 days,
I
not
agree,
problem.
Ivan. Yeah. You need shorter.
5 days, $1,000.
I think it will be a bigger damage for the whole industry if it goes down.
Yeah,
And
I
the
agree.
reason is because a lot of brokers on the B2C side, they are not ready for this, and it will affect the whole thing. So I won't give you the answer from my side, but I will give you the answer for everyone.
Yeah, for
So because we are all part of this system, so I believe if it goes down 1,000, it will be a systemic issue, in my opinion.
Yeah, I agree.
I agree with Andreas.
Down.
And I can't
I
believe we
agree
are
with
even
Andreas.
discussing something like that, 1,000 down, which is possible now. We don't know we might happen.
It's not that far off. It can
Exactly.
do it in 2
I
days.
mean,
You know?
yeah.
So you think down. All of you down? Anyone thinks up is a problem? Up is a problem?
Yes.
I think up or down is a
Majority,
problem.
despite the retracement we've seen, there's still a lot of customers long. And broker dealers, obviously by nature, they are risk takers. That's part of their business model. So I think majority as a whole, and you can look at CME, positioning, etc., the market is still long at this point in time. I don't disagree one bit with the fact that if it goes down, we'll have auto liquidations going mental, and then we run into this negative equity, go chase someone, good luck.
We can have an S&P event,
On
if it goes down.
On a realistic scenario, I think if it goes down, it will be much more damage for the whole industry, on a realistic scenario. On a proper scenario, like you said, so if everything is in place, it shouldn't affect either.
Yeah.
But it's not the reality.
Thank you, everyone. We've got to the end of the time. This was very interesting, actually, and quite interactive this time. So I thank you all for joining me today, and thank you all, everybody, for attending this, and thank you for IFX for hosting us as usual. And that's it. Thank you.